William L. Clayton Professor of International Economic Affairs at Tufts University. Professor Klein served as the chief economist in the Office of International Affairs of the United States Department of the Treasury between 2010 and 2011. He is a research associate at the National Bureau of Economic Research, and importantly, the founder and executive editor of Economifacts, a nonpartisan website that provides economic analysis on timely policy issues. This is very important, so especially for our CD fellows, for your term projects, debates in my class as well. So I know that you're already using, and I highly encourage that you will continue to do that. Professor Klein has been a visiting scholar at the IMF, the Board of Governors of the Federal Reserve Board, the Bank of England, and Federal Reserve Banks of Boston, New York, San Francisco, and Dallas. His research focuses on international macro and widely focusing on capital flows and the impact of trade on United States labor markets and the determinants of foreign direct investments. And today he will present us Gates and Rates, Capital Controls, and Monetary Policy. Thanks, Michael.
Well, thank you very much. It's really nice to be here. I have to thank Ken Kuttner for the rhyming title. And also, we didn't plan it this way, but my talk is going to very nicely complement Professor Chang's talk, which shows that we've been hanging out together for 30 years and go to all the same meetings. This is mostly about the policy trilemma. And how many of you are in Professor Kim's course? Okay, so you talked about this on Tuesday, right? And basically, this is all you need to know about international macro. There's a story that the Jewish sage Hillel was approached by someone who's very derisive. And he said, can you tell me the whole Torah, the whole teaching of Jewish law while standing on one foot? So Hillel did. He said, don't do to others what's harmful to you. The rest is commentary. The policy trilemma holds. The rest is commentary. And so this is really the core idea in international macroeconomics. And there's an important question of, well, first let me describe what it is. Some of you have seen this, but the idea, the naming of the idea comes from Maury Opsfeld and Alan Taylor. And by the way, Maury Opsfeld's going to be a guest on an Econofact Ask Me Anything webinar on Tuesday at 4 o'clock. That's for premium subscribers. It costs $50. Maybe Williams College will pay for it for you. So the idea is that they got very excited because Maury is this great intellectual, and he has, maybe the only economist in the world who has the Oxford English Dictionary, both volumes, in his office. And he and Alan came up with this idea of a trilemma instead of a dilemma, and they looked to see if that word existed, and it didn't, so they coined it. The idea is the following. At the corners of this trilemma are three things that, as a policymaker, you might be interested in. One is the independence of monetary policy. Another is exchange rate management. And the third is whether you want to allow capital to come in and out of your country. And the trilemma part of this is you can only choose two out of the three. So either you can be at side A and you can have fixed exchange rates and open capital markets, or you can be at side B and have floating exchange rates and open capital markets, or you can be at side C and you can have fixed exchange rates and closed capital markets. So because this is sort of the foundational idea in international macroeconomics, and nobody gets tenure for repeating the foundational idea ad nauseum, people have looked at whether or not you can round off the corners of the policy trilemma. Is there some scope for getting around this trilemma, this idea that you can only get two out of the three? So Jay Shamba and I have a paper which is called Rounding the Corners of the Policy Trilemma, but I like Gates and Rates better. And that previous picture is descriptive, but it's not analytical. Here's the analytical part of this. A central sort of concept in international macroeconomics is what's called the interest parity or uncovered interest parity, which Roberto referred to. And the idea is that basically with arbitrage, bonds that are denominated in different currencies but otherwise similar should pay the same rate of return. Otherwise, there'd be, the proverbial $20 bills lying around. What does that mean in terms of this equation? Well, domestic interest rates on the left side have to equal the foreign interest rate and the expected rate of depreciation of the domestic currency. So the expected rate of depreciation of the domestic currency, if you buy a foreign bond and your currency depreciates, when you trade it back in, you're going to get more of your own money. So you have to be compensated for that with a higher interest rate. This is how you can understand the correlation between this and that diagram. The interest rate, the domestic interest rate, is domestic monetary policy. Foreign monetary policy is I star. We take that as exogenous, but I'll describe some situations about that further. The exchange rate is, E to the subpart T, and the expected change in the exchange rate is 0 if you have a fixed exchange rate, not 0 if you don't. Very importantly, the expected future exchange rate is an indicator of the credibility of policy to maintain a fixed exchange rate. And that doesn't always work so well, as we'll see. And it could be the case, sort of alluding to some of the things Roberto was talking about, that this is an incomplete equation. So I'll talk about that in a minute as well. The equal sign is one of the corners. It represents capital mobility. You need to have an equilibration here for the arbitrage to occur. And if you have that, then you either choose domestic monetary policy or an exchange rate policy, but you can't choose both. So that's all of international macro in a minute and a half. I would tell you how much it was, but the clock back there broke now. Now, there's some dramatic examples of this. When Russia invaded Ukraine, the ruble dramatically depreciated. So at the right end of that, you see this big spike up. And the Russian central bank was very concerned about this because what it meant for the average Russians was they would see the value of their currency would fall dramatically. So they did what lawyers call belt and suspenders. They not only raised interest rates, but they also put in place even more severe capital controls. So that's an example of how the interest parity diagram illustrates why, in this case extremely why, a central bank and monetary authorities and the government as a whole were trying to control the value of the exchange rate. So how can you round the corners of the policy trilemma? Well, one thing is perhaps you can manage expectations. So how do you manage expectations? And can you in fact do that? So Roberto was talking about foreign exchange intervention. And one of the theories behind foreign exchange intervention was that what it would do is signal to the market what your intentions were. And in that way, it would manage people's expectations of what the exchange rate would be in the future. And then you sort of round the corners because you have effectively another policy tool. And as Roberto indicated, you have to do that through sterilized intervention, which he kindly illustrated, so I don't have to spend a minute explaining that. Because otherwise, when you're doing, when you're trying to do, well, you could do it through sterilized intervention, right? And then you're insulating monetary policy from this effort to try to manage expectations. So as an aside, Maury Obstfeld wrote his dissertation about sterilized intervention, and when he was giving job talks, his paper was called "Does Sterilization Work?" And people would come and listen, and then like after 5 minutes, a bunch of the audience would leave and he'd get really upset. And then he realized they were from the School of Public Health. So different kind of sterilization here. The question is, why do you have to do it through sterilized intervention? So, economists have sort of tied themselves into corners and sort of said, well, it implies greater credibility because you're putting your assets at risk and so on. And I spent a lot of my early career looking at this. And my conclusion, sort of along the lines of what Roberto was saying, is it doesn't work except. It seems to work when there's a situation where everybody kind of knows that the exchange rate, for example, is greatly overvalued. And they're just waiting for sort of a trigger moment. So what we saw in the September of 1985 at the Plaza Hotel in New York, there was a meeting of the G7 finance ministers from the biggest economies. The dollar had been on a strong upward path for 5 years. It came down a little bit in the beginning of the year, but then that depreciation stalled. So there was this meeting at the Plaza Hotel. And by the way, another good reason to study international economics is like we have Bretton Woods, which is this gorgeous resort, the Plaza Hotel. If you do security studies, it's like the Akron Accords. So, want to stick with international macro. So they gave this announcement and the dollar plummeted after that. And so that really sort of piqued the interest of international macroeconomic researchers because it seemed like sterilized intervention worked. But after I did a lot of work on this and read what other people did, it seemed like it worked because everybody kind of knew the dollar was overvalued and they were just waiting for a trigger moment. And that was a trigger moment. But systematically, it doesn't seem to work. And, as Roberto said, and I would agree, there's very little evidence that sterilized intervention works. Now, another important point here, though, is that if you lose control of the expected future exchange rate, you can have a self-fulfilling expected devaluation. So what would happen was, suppose you have a fixed exchange rate. That means the term in parentheses has to equal 1. So your domestic interest rate equals a foreign interest rate. In that case, suppose people no longer think you're going to be able to peg the currency and the expected future exchange rate depreciates. That is, it rises. Well, to keep the peg, you have to raise your domestic interest rate. When you raise your domestic interest rate, that causes a recession. What's a relatively easy way to get out of a recession? Maybe depreciate your currency. But people realize that, and the expected future exchange rate, the weight on the probability of devaluation goes up even more. You have to raise interest rates even more, and eventually you have to give up. So in that way, an expected future devaluation can cause a devaluation. So there can be this sort of self-fulfilling aspect of this. And a good example is what happened in Argentina. So Argentina had very, very high inflation in the 1980s. And President Menem comes in and he has a finance minister, Domingo Cavallo, and they introduce the convertibility plan, which pegs the peso to the dollar 1-to-1. It also has, you can freely buy and sell dollars and pesos. So it's really kind of a very sort of high risk, high reward plan. And so what you see at the beginning is that the interest rates on peso deposits in Argentina are much larger than interest rates on dollar deposits in the United States. Why? Because people don't expect the plan to work. But in fact, the plan starts to gain credibility. And this spread in interest rates shrinks and shrinks and shrinks, although there are periods where it spikes. So at the end of 1994, there's a crisis in Mexico, and investors are looking around the world saying, who's next? Well, Argentina's always next. So there's an attack, but they hold. And then it goes back down. A few years later, there's the Asian crisis. There's another little spike. There's a Russian crisis, a Brazilian crisis. So there are these spikes. The problem is that over time, inflation does come down dramatically in Argentina. In that way, it's a success. But if you think about competitiveness, which is not only the exchange rate, but the inflation differential, there's built-in very high inflation differential, and you'd actually have to have deflation to offset that. So after a decade, it starts to look like, well, we're not going to have deflation. Inflation has come down, but we're still very, very uncompetitive. So towards the end of the decade, people sort of realize what's happening. There are different sort of efforts to sort of save this by Cavallo, but eventually it breaks apart. And then the first part of this century, there is great monetary instability in Argentina. So this is a really good example of how the expected future exchange rate can drive policy when you're trying to maintain a peg. Another way you might be able to round the corners of the policy trilemma is that there might be another term here, what's called the risk premium. The risk premium is what extra do you have to get in order to hold, in this case, domestic bonds? And the question is there a risk premium? And if so, is it exploitable by the central bank? So in the early 1980s, the Federal Reserve Board of Governors had a lot of research on this, and they tried to figure out this, what's called portfolio balance model, whether or not it was working, whether or not it sort of explained what was going on, and if in fact you could control the risk premium. And the name portfolio balance has to do with you're not only interested in the average return, but the volatility of your return as well. So portfolios matter because if you're holding more in a risky asset, you have to be better compensated to do that and so on. The challenge to empirical researchers is that neither the risk premium nor the expected future exchange rate are observable. So you can't really tell whether or not the equation is like this or without the risk premium. And furthermore, if you think about the size of the foreign exchange market for industrial countries and the size of reserves of central banks, the size of reserves of central banks are not big enough to move things around. So, to my mind, sort of this way of rounding the policy trilemma has also been discredited. So what about a third alternative of cutting off the equal sign or limiting the equal sign? So this is where we get the title, or where Ken got the title, which I then happily adopted, of Gates versus Walls. A paper that I wrote for the Brookings Papers on economic activity, I guess like 13 or 14 years ago, is called Gates versus Walls. And the idea came to me when I was attending a conference at the Peterson Institute where Kristen Forbes was talking about capital controls. And I started to think, well, not all capital controls are the same, just as not all inflation targeting is the same. There are capital controls that have been in place for a long time across a very wide set of assets. There are also capital controls that are attempted to use episodically. So I was writing this paper and I took a bike ride, and we have a house in Beckett in southern Berkshires. And I saw this beautiful stone wall, and it came to me, I could call it Gates versus Walls. So a gate, pushing the metaphor a little bit further, a wall is there, blocks you from going in or going out. Gates, they can be rusty, maybe they don't close so well, maybe you close them too late. So I had this idea that there's a fundamental difference in capital controls that are long-standing and across a very wide set of assets, and capital controls that are put in place episodically over a more limited set of assets to try to affect current conditions. So I went around and sort of tested this and thought about this and have a number of papers, and the one I'm going to talk to you about today is a paper with Jay Shamba. So the idea here is you still have the interest parity equation, but it doesn't matter because you've gotten rid of the equal sign. And then the question is, by getting rid of the equal sign, have you obliterated it forever, or are you trying to just episodically move it in or out? So what's the evidence on that? So this is our paper. We look at data of capital controls. And so this is underappreciated how for the students, you come up with these ideas of, oh, it'd be really great to do a paper on what makes people fall in love. And you say, okay, what's the data set? And said, I don't know. Well, finding data on capital controls is maybe a little easier than people falling in love, but it's not that much easier because with exchange rates, you can have, and Jay developed this fixed exchange rate measure, and there are other ones as well, but you actually have the exchange rate. So he has this measure of you have a fixed exchange rate if over the course of a year, it doesn't change by more than 2%, or a soft one would be 5%. And over, within the year, it never moves by more than that. So you have a market measure of that as well. The challenge then is to say, well, what's the base country? Because when countries peg exchange rates, almost always it's to one other currency. How many currencies do you think serve as base countries? Well, there are 5, but it's mainly the United States, Great Britain, now the euro, but before that, the franc or the Deutschmark, and then also, I guess, 6, the South African rand for, I guess, Botswana, and the Australian dollar for the small island nation that I'd never heard of before, Kiribati, I think it is. But basically, there are very few sets of them. So Jay had to figure out, if you're pegged, who are you pegged to? And if you're not pegged, who would you have pegged to? And he uses historical data. So that's sort of, he spent a long time doing this and is very successful as his dissertation, and he got a lot of papers out of that. I got a paper out of that too with him. With capital controls, it's much more difficult because you would need sort of what would capital flows look like but for the controls, and you don't have a good measure of that. But there is a de jure, not a de facto, but a de jure measure from the IMF's annual report on exchange arrangements and exchange restrictions, which was mentioned earlier today. So what we did is we had people go through these reports year after year after year, and we came up with these indicators of capital controls for a very wide set of assets for a lot of countries on an annual basis. And this data set is actually available. I did it with some others. It's on Martin Uribe at Columbia's website. So when we wrote this paper, we had data between 1995 and 2011. We had 91 countries, over 1,200 observations, and we divided it up based on the number of controls and so on, into countries that had open capital accounts. So examples of that were Denmark and Spain. In the 80s, Spain didn't have an open capital account, nor did other European countries until 87, when there was sort of the new EMS. Countries that had what we called walls, pervasive, long-standing capital controls, were countries like China, South Africa, India, and Russia as well. And then sort of the interesting case is the intermediate case. Countries that had limited capital controls, episodic capital controls. So there we have countries like Brazil, Iceland for a short period. Chile had an episode with that as well. And so what we did was we ran this regression. So we ran it in 2 different ways. The most intuitive way is to think about dividing the data up into subsets of fixed versus floating and open versus closed. That's the simplest 2x2 system. So this represents the change in the policy interest rate in your country as a function of the change in the interest rate in what was determined to be the base country. And the idea is that the beta here should be, well, in an extreme case, 1. If you have a fixed exchange rate and open capital account, you have to follow the interest rate of the other country. Now, it's not really 1, as it turns out, because fixed exchange rates aren't fixed exactly. They're fixed within bands. And it turns out there can be quite a bit of fluctuation. So Maury Opsfeld in a paper with Jay and Alan Taylor sort of analyzed if you have an exchange rate band using the target zone analysis of Krugman, you can actually get a pretty big fluctuation. And you would get a beta that can be as low as 0.5 and still have a fixed exchange rate. So it's not literally one, but the important part is the comparison. Is it different if you have a fixed exchange rate or a floating exchange rate? Is it different if you have open capital accounts or closed capital accounts? So just to illustrate and fix the idea here, this is a 2x2 case where we just have open and non-open capital accounts and fixed pegs and non-pegs. And what you would expect to find is what we found, that the biggest coefficient is for countries that peg their exchange rate and have open capital accounts. And then if you have a floating exchange rate, so on the northeast corner, and open capital accounts, you still might have a positive correlation because there are common world shocks. But it's not as big as if you have a fixed exchange rate. If you have closed capital accounts, you still have some correlation, but it's not as big. And the differences here are important. So the differences, which are in the margins, are statistically significant. I'm keeping track of the time too. 5 minutes, right? That's what my clock says also. So this is Gates versus Walls. So here we have, instead of a 2x2, a 3x3 indicator. And the difference here is we have peg, soft peg, and float. Soft peg is a 5% band as opposed to a 2% band. And we have open, mid-open, and closed. Mid-open is like a gate. It's these countries that use capital controls episodically. And so you see again, sort of from the northwest to the southeast, the coefficients get smaller and are no longer significant. You aren't following the base country change in interest rates so much. If you look across the top row for open versus closed, there is a significant difference in the coefficient. If you look down the row, a peg versus a float, there's a significant difference as well. But the message from this is pretty much that gates don't work systematically. That if you're trying to use capital controls, but only episodically, there are ways around it. And so after I wrote this paper, I spoke with Jose de Gregorio, who had been the governor of the Central Bank of Chile, and he really liked the paper because Chile made this effort in the early 90s to use capital controls, and he was saying this is not a good idea, and in fact it wasn't, and they found that it didn't work out well. Why don't gates work well? Well, Brazil had a similar experience where they tried to use capital controls first on a limited set of assets. So people started saying, well, we're going to use this other asset instead. So they widened it. And then they said, well, we're going to use these, the investors said, we're going to use this other asset instead. And they widened it further, and finally it just broke apart. So there's one way in which, if you try to limit the set of assets, people will find ways around it. There's another way in which, if you have long-standing capital controls, you have in place government authorities who have experience in trying to prevent people from moving money in and out of a country easily. But if you're trying to do it episodically, you don't have that kind of institutional knowledge. So it becomes very difficult to do. So the summary of the results is that the peg and the soft peg and the float are different, and the open is different from the closed, but the mid-open is not, that is, the gates are not so different from open. Then finally, what about what you want to use this autonomy for? So a standard sort of Taylor rule is saying, well, monetary authorities are going to try to affect unemployment and inflation. That's like Humphrey Hawkins. There's something similar in other countries. I guess Peru, it's only inflation. But there's something similar. So in fact, is there evidence that when you have in place fixed exchange rates or capital controls, you in fact are able to devote or when you have in place fixed exchange rates, are you unable to devote policy towards these domestic goals? The capital controls save you in that way. So what we have here is sort of these Taylor series augmented with the interest rate in the base country. So what you see is for pegged countries, in the first column for advanced countries, there is a close alignment of the change in the domestic policy interest rate with the interest rate of the base country. But if you look jointly at the change in inflation and the change in GDP, there's not a statistically significant effect. So they have to use their monetary policy to preserve the peg. When you have a floating exchange rate in the right-hand side, right column at the top, there's still this correspondence because there are common global shocks. However, you can also devote policy towards inflation and unemployment or GDP growth. For emerging markets, you also have sort of similar results that you can use this. What we get here is that you get sort of the wrong sign for inflation, but it's insignificant. So some of this goes back to what Shedman was talking about last night. These are policy interest rates, and Roberto also mentioned this. And there's a spread between the policy rate and the relevant rate. And so the relevant rate for people is the market rate, and there can be changes in the spread. So when Roberto was talking, I was thinking, well, if you could manage the spread, and we ran the same equation with not the policy rate, but other interest rates, what would it look like? The question is, with the spread, it's a lot like the question with the risk premium. Do you have a systematic control over the spread? And if you don't round the corner of the policy trilemma because it's moving around, but you can't affect where it moves. So the conclusion from our research was that the trilemma appears to be alive and well. Exchange rate and capital control regimes help explain the extent that a country moves its policy interest rate with that of the base country. You can gain autonomy in a country by either floating or strongly closing capital markets. A soft float, we found, offers some monetary autonomy, but episodic capital controls don't really seem to work very well if you want to sort of try to gain monetary autonomy. So happy to take any questions about that.
Thank you, Michael, for your insightful talk. Now we have like 5 to 10 minutes for questions.
Or we could just get coffee now.
Also, there's a question.
Good afternoon, Professor. I am Monzur Morshed from Bangladesh. Actually, it's an interesting talk. I wanted to know, I mean, you said there is some control on the capital flow. So I think if we put so much control on capital flow, so much walls, so it will also, I mean, disincentivize the countries to go for rapid industrialization, and there will be shift from industrialization to agriculture. In past, it was agriculture to industrialization. So if there is so much control on capital flow, it will be reversed to agriculture. But thing is, we need to, I mean, understand that it is not only just making money. Also, we need to focus on weather, climate, mental health, like overall all sort of issues. So in that case, instead of putting so much control on capital flow, there should be some kind of fair competition among the countries to innovate for better life for humanity, things like this. So in this case, what I want to know your thought regarding this this kind of sustainable growth. Thank you.
So like Roberto said, you know, macroeconomic stability is important, but there are a lot of other things that are important as well. Macroeconomic stability has to do with the aggregate economy. It doesn't say anything about distribution. You know, hopefully economic growth helps alleviate poverty and reduces inequality. But that still doesn't say anything about environmental degradation. So that's well beyond the scope of, you know, this paper, or maybe macroeconomics more generally. Um, of course, you want to think about all these other issues, but you don't want to cast a net so widely that you're thinking about, you know, A and B and C and D and E and F and G and H, such that you have nothing to really say. So I think it, you know, in your education here, you want to think about how to identify a question that I can address. And, you know, one of the great challenges in economics or in social policy is how do you ask a good question? It's much harder to ask a good question than to provide a good answer to a good question. So there is a Nobel Prize winning physicist, Isidore Rabi, and they asked him, how did you become such a great physicist? And he said, when the other boys came home from school, their mothers would ask them, what did you learn? When I came home from school, my mother would ask me, did you ask a good question? So I think it's really important to ask, you know, narrow, well-defined, tractable, answerable questions. So the things you are saying are very important, but it's such a wide question that it'd be very hard to, you know, provide sort of a single answer. You want to have a lot of people working on a lot of these things to provide answers to each part. But, you know, there's no sort of silver bullet. Do you know what that phrase means? Okay, so silver bullet kills a vampire. So more information from me than you need. So, you know, there's no single silver bullet, but there are lots of different policies that are important. And macroeconomic stability is, of course, really important for the welfare of people. Ken?
Just a second.
That's if I have the microphone, I'll use that. So I don't remember which countries are in the data set you and Jay used. I think primarily emerging market economies.
Yeah, there weren't really developing countries so much.
Yeah, and that was going to be the thrust of my question. I can say that equal sign in the uncovered interest rate parity condition for sure applies to Philippines, to sort of some of the upper income, or at least approximately to the upper income emerging market economies. To what extent is the trilemma also a constraint for countries for which the financial flows are weaker, for which maybe the foreign exchange markets aren't as developed? Is that equal sign as hard a constraint as it would be for, say, the Philippines or Thailand, or would countries like Somalia or Kyrgyzstan actually have more face rounder corners, even in the absence of capital controls?
So remember, the equal sign is because there are international investors who are arbitraging away differences. And if there's not a robust, you know, market for Somalian debt, then, you know, it doesn't matter as much. So this is something that's more relevant for advanced countries and emerging markets. For developing countries, you know, there's more latitude. On the other hand, for developing countries, the way monetary transmission works is distinct as well, right? So it could be not through a policy interest rate, but policies with banks, or even, you know, sort of informal financial markets. So, you know, when we're talking about, and as people have been doing, you know, earlier today, when you're talking about monetary policy in not emerging market countries, but countries that have less financial development than that, then it really becomes, I think, a very different issue. And, you know, I don't have as much to say about that because we're starting to get away from this paradigm, which is relevant if there is scope for international arbitrage. Oh, you have a question?
Nur Sultan always.
Thank you very much. Professor, in your last regression table, I just want to just clarify that for emerging markets, why float exchange rate regime's coefficient is insignificant. Just want to know the reason
Oh, well,
for emerging
yeah,
markets.
so
Yeah.
you would expect it to be insignificant anyway if there's a float, except to the extent that the base country and the domestic economy are responding to common global shocks. So for the advanced country sample, you know, if the base country is the United States or Great Britain, you might think that for that subset, the shocks that are hitting Great Britain or the United States, or you know, we had Germany and France, they're going to be similar to other advanced countries. But for when you also include emerging markets, maybe there's enough distinction between the effect of global shocks in those countries. But that, you know, lines up very well with the sort of the simple-minded theory that there shouldn't be any correlation if you have a floating exchange rate. Okay, well, thanks very much, everybody.
Thank you. Thank you very much. This closes our session. We have a coffee break now, and then it will be followed by the closing plenary address. Perfect on time.